Hello, and welcome to Rocket Fuel, your daily update of everything that's happening in the Rocket Pool community. My name is Wack. Today is March 22nd. Today's episode is going to cover max effective balance EIP to be included in the Pectra hard fork. We also have a new update to the DeFi opportunities using our rETH and RPL, and also we're going to be talking about Coinbase and what they're doing for the health of Ethereum. So stay tuned, let's get started.
10, 9, ignition sequence start, 6.
Okay, so the first thing we're going to be talking about here is this tweet from Christine Kim saying, woohoo, Max EB is going into Electra, and that's Electra Prague, which is like portmanteau is Pectra. So we're getting max effective balance. Now, for those of you who don't know, max effective balance will be a new way of setting up your validators. So it's not going to be in multiples of 32 anymore. It can be from 32, which is the minimum effective balance, all the way up to 2048, which will be the new max effective balance. So the benefit of this will be is that solo stakers, home stakers will be able to compound our ETH a lot more quickly, because we don't have to wait until we get multiples of 32 as we currently do. You know, right now you have 32 ETH, you earn 32 ETH of rewards, you can start a new validator. On Rocket Pool, you have 8 ETH, you get 8 ETH of rewards, you start a new validator. It's really inefficient, you know, for that long period of time that you're using to wait to get the extra 8 ETH. With max effective balance, you'll be earning, compounding those rewards. Like any new reward that you earn will get staked. So you'll actually get compounding rewards instead of like a linear rewards, which is really, really exciting. So it's going to be a really nice upgrade. Another, of course, huge benefit is that the total number of validators on the network will go down, you know, hugely. So potentially like maybe down 10x, if not more. So if you have 1 million validators and you get Pectra, you get the max EB in Pectra, then you could potentially go down to like, you know, 100,000, maybe 200,000 validators, which is still like an 80% reduction. And that's because there's so many validators who'll just be able to consolidate their stake into fewer validating nodes, I guess, new validators on their nodes, instead of having, you know, many hundreds of, many tens of 32 ETH validators. So this is the EIP over here. This is the new number that we're going to have to memorize. So that is EIP 7600, and this is going to, you know, be in Pectra. It looks like because they're including this in Pectra, it will likely be that it will come in Q1 of 25. So you know, there was this idea that Pectra could be like a skinnier update, like a, you know, a lighter update. But with things like EIP 7600 being included in there, it makes sense that it might be a little bit later, and that actually is good for Rocket Pool. It gives us a little bit more time to get everything on the, you know, Saturn upgrade ready, and makes it a little bit more likely to even potentially be everything in one upgrade or in 2 upgrades instead of more than that. So let's go to the Rocket Pool community and see what the reaction for this is in Rocket Pool. And so here Patches says this is incredibly sensible methodology actually. And then there was like some discussion about like about how it's going to work out, and like what it might look like for Rocket Pool. People kind of like started bouncing ideas around about you know, what it's going to mean for Rocket Pool, right? Like, because we have mega pools coming in. Mega pools is kind of similar but not similar to Max EB in that you know, currently every validator you have is on a separate contract, and then mega pools is just going to put it all into one contract, one mega contract. So it'll make it a lot easier for you to stake you know, multiple validators, but it won't necessarily help you compound in the way that max effective balance does. So it will be changing some of the design parameters for Rocket Pool. But if you want to follow this discussion, you know, here we had ETH Dreamer who got involved in it as well. So ETH Dreamer was I think someone who was involved in that. So just talking about how it's going to work, and basically the idea is that, you know, because we are getting mega pools, non-fungible Yoakum here says that just that it would be nice to be able to consolidate validators securely that don't share the same withdrawal credentials, so we can migrate to mega pools without exit and re-entry. So the idea with mega pools is that, people will have to exit their stake and then re-enter their stake on the new mega pool contract. And of course, that churn is bad. It costs gas. It's a friction to progress for Rocket Pool. Well, if there was a way to do it so we could do it. Well, okay. So on the Ethereum side, what they want to do is like anyone that shares the withdrawal address, they can do automatically. So if the withdrawal address is the same, however, with Rocket Pool, every validator has a separate smart contract withdrawal address, so they all have different withdrawal addresses. Your withdrawal address for Rocket Pool is not actually the Ethereum withdrawal address, which is what the issue with the Starknet airdrop was, because they airdropped the token to the Ethereum withdrawal address, not to the Rocket Pool withdrawal address. So non-fungible Yoakum here says that it'd be nice if we could do that with multiple withdrawal addresses and kind of like put them together. And Ethereum says if we enable execution layer initiated consolidation, then we can do this. And then Ramana says we're going to do a mega pool migration with exit and re-entry anyway, right? Like that was always the plan. And non-fungible Yoakum says that's the baseline at the moment, but because if we can avoid it, then that would be really good. So Ramana says because somehow or another we have to deal with the fact that we have disparate withdrawal credentials scattered across Rocket Pool nodes validators. Oh, and then he says, I guess you're hoping for a hard fork to let you change withdrawal credentials. Fair, or effective change, e.g. consolidate into a different one. And then ETH says as well, with execution layer initiated consolidations, you could do it without withdrawing. So this is actually like a really nice idea. Of course, this is really early, so let's try to see how let's see how it all plays out. And then we got some feedback from the team as well. So here, Shadon asked the question of Langas about how does Max EB change the megapools design? Like, is it still going to be used? Is it moot now? And Langa says basically what Amana said. He says we still need megapools, but it may change how we interact with the beacon chain. Instead of a deposit spinning up a validator, it can just add to an existing validator up to the limit. There are potentially downstream changes to other areas of Rocket Pool as well, but that's how it relates to megapools. So that's going to be really interesting to see, how it's going to play out, because it looks like the team will now have to redesign megapools a little bit, which is disappointing, but hopefully it's not too bad, and everything can be done, promptly. Let's hope. Okay, next we got this really big news out of Coinbase Cloud. So we covered this on Rocket Fuel a few weeks ago with Coinbase talking about how they are moving some of their execution clients of their validators from gETH to Nethermind, and then the next step will be to share it out between gETH, Nethermind, and Aragon. Well, they just completed their move to Nethermind, and 50% of Coinbase's validators are now running on gETH, and 50% of them are running on Nethermind, which is really exciting. So that's great news. That is a huge boost to Ethereum's health. And then if we have a look at the client diversity website, it's actually upgraded to show that gETH is now 66%. So while, I'm not taking a victory lap here and saying that, we fixed the problem, it's very likely now, in fact, almost certain now, that we are below 66% threshold because of people like underreporting, and, a whole lot of people who aren't included in this analysis have moved. But this is actually really wonderful news. Like, I just wish that, we can keep going and keep moving on this. I think, once Aragon, Aragon is fine the way it is, but once rETH becomes a more usable client, then, we'll have a much better client diversity on the execution side, kind of like we do with the consensus clients right now, because each new one that comes online kind of eats the share of the previous ones. And then eventually gETH, will trend down towards less than 33% ideally. So even if there was a bug in any of the clients, then it wouldn't cause any finality issues. So yeah, huge shout out goes to Coinbase for this. So, client diversity.org now shows 66% for gETH, in reality, it might be a tiny bit less, but let's not, rest on our laurels. Let's keep pushing forward with this, because I think that we can do some really good stuff and like really get those numbers down in the next year or so. I think we'll be in a really good state. So congratulations to everyone who's been pushing that, including the ETH Staker team and a whole bunch of other people as well. Good stuff. Okay, next we have the new update of the RPL DeFi sheet. So here you have stake rocketpool.eth, and they're saying risk optimized DeFi with Rocket Pool and PancakeSwap for rETH, and rETH is paying over 19% APR. This is the second update in a row where PancakeSwap has been the best strategy. So it says the RPL DeFi guide is here. So let's have a look. So here, there's 73 RPL every day and 390 cake every day that is going into this pool. And they are paying out, like it said, 19% at the moment, which is absolutely amazing in terms of rewards, 19.24%. So that is on mainnet, I think. And then there's some other rewards here as well, where you can see, on layer 2s, whatever your favorite layer 2 is, like whether it's ARB, Optimism, Balance, or Base as well. Like there's some really cool opportunities for you to find some yield on those. And here, you can see percentages of like a high single digit or like 10 to 12%. And then on ETH mainnet, you can earn RPL with ETH and Cake, and a bunch of other things as well. So definitely go and check those out. But that PancakeSwap pool is actually like legit, like 19%, which is amazing. And then if you want to have a look at the full sheet, then you can go to rpldefi.com. Is it rpdefi? rpldefi.com. Yeah. And you can see what's going on there. It's like it's got the best stuff listed, with their active strategies. But you can't really go wrong with that PancakeSwap pool right now. They're doing some really cool stuff there. So that's awesome to see. Let's get back to the Discord, and here there's some research that Ken shared today. So he says a few things to share with the community. First, Ramana, this paper, and then there's a link to a paper, did an analysis of liquidity positions and LT. I'm not sure what that stands for. Profits for LST tokens. They were perplexed in looking at the arbitrage patterns for rETH and reported the following. This is our findings revealed at least 2037 successful flash loan based rETH arbitrage transactions consistently occur after a staking transaction TX stake issued by the same arbitrager. In other words, transaction arb and transaction stake are placed in the same block and possess consecutive transaction indexes. Our empirical findings indicate that arbitrageurs encounter a substantial entry barrier, necessitating an average stake of 16 ETH as a prerequisite for participating in the rETH arbitrage. So what they're not noticing is that this is, the rocket arb being used, and they couldn't figure out what was going on. So they thought that there needed to be some kind of arbitrage happening, some kind of staking happening to make it possible for the arbitrage to happen, which of course is true, right? Like, you can only arb the deposit pool if you're staking in that same block. But like for someone not understanding how Rocket Arb works, they're like kind of perplexed, which is really funny. Also, the same paper, they said that liquidity provisions with LSTs not always result in higher returns compared to simply holding the assets. And then there's another paper where liquidity staking tokens and automated market makers found that fully staking is more profitable for many pools, because what happens is with these liquidity pools is, you have half rETH and half ETH, or wrapped ETH, and then you put it in a liquidity pool, and then you earn like rewards on that. And what they're saying is, like, for the most part, like just holding the rETH would actually give you better rewards. However, like I'll come back to that in a second. So they said fully staking is more profitable for many pools. They stated that rETH on Curve version 2 with LPing was only more profitable than liquid staking with rETH because of the Curve rewards. It says this causes me to ask the question if the IMC should be providing liquidity incentives versus just using the deposit pool as the liquidity reservoir for rETH, and they said that the academic paper is definitely worth a read. So right away, Yoakum said that they're looking at the wrong pool, basically. Like, Curve is not a good place to look because the IMC is not incentivizing Curve pool. The IMC, of course, is doing, incentivizing PancakeSwap, which a lot of people use, the balancer pools and gamma pools, and these are the ones that, have really good rETH liquidity, and they're the ones where you can like significantly outperform just holding rETH, as of course, I just showed you a few seconds ago. And says, as for just using the deposit pool, that's fine as long as there's ETH there, but there's no guarantee of that, and all of that is available at Peg, so it's pretty low friction to getting drained in the run, and without substantial secondary market liquidity, things get pretty rough on the Peg. And when we're much smaller, it was a pretty inefficient way to make liquidity. Nowadays, it's not as efficient. So there was. I said, this is so good. 2037, like that's how many people have used Rocket Hub. Wow, someone gave Ramana money for this. And he said, I already got some money. And I'm saying more money because yeah, that's really great. Okay, next we've got news here of the marriage season in the Rocket Pool community. So I mentioned in yesterday's episode that Love Points is wanting to get married. Well, today we also have news of Patches wanting to get married. So it seems like Patches has some extra RPL, and he doesn't have enough ETH to make use of it. And he wants to, once Houston goes live, he would like to get married with someone. Patches would be providing the RPL, but also running the validator, and the other person can provide the ETH. And he says, looking for someone who has the ETH to keep my collateral under 25%. So I think that works out to be somewhere around, let me think, around 10, 12 validators, something like that. And of course, under 25% is that sweet zone of RPL rewards under RPIP 30. So then the discussion started, like how much ETH would that be, and why Houston? So, Ramana asked why Houston. So of course, Ramana made the rocket split contract that we talked about yesterday. With Houston, of course, it's happening at the protocol level. You don't have to trust other smart contracts in the same way that haven't been audited, whereas, the Houston upgrade will be fully audited by the best in the business auditors. So that is kind of like with the reasoning there. But it seems like there's a bunch of people who kind of want to get involved in marriages, and they're either now starting to explore the rocket split, or looking into doing Houston marriage nodes through Houston, basically. So I think, like, I know that I've been saying this a lot, but I'm so excited about Houston. Like, for a while, like, I'll have to be honest and admit, right, like, I just thought that Houston was going to be like a decentralization maximizer like upgrade for Rocket Pool, and I was kind of like disappointed that it wasn't going to have any scaling impacts or anything like that, or bring more users to Rocket Pool. However, I think, like, fully understanding the stake ETH on behalf of function and having the separate withdrawal addresses, I think what's amazing about that is, like, it's just shown me that there's a lot of really bullishness kind of like hidden under the surface of Houston upgrade, and I think that's something that I'm really excited about, especially when we kind of let ourselves start dreaming and thinking all these institutions that might be coming in that they want to stake with Rocket Pool because they'll get extra rewards, but they don't want to hold RPL. Well, we've got 10 million RPL in the community that are not staked, and those could be married with those institutions potentially. And that's me just like getting way ahead of myself, but that becomes reality with Houston, and that's what I'm really looking forward to now. So yeah, if you want to get married to Patches, you got to bring ETH. You got to have about 100 ETH, I think, to or maybe like a little bit more, like between 100 and 150 ETH to get married to Patches. Patches is quite demanding. He wants the person he gets married to have a lot of ETH there, so good on you, Patches. Okay, next we've got news of a client update, and this client update is a Lighthouse. So they've got a new version of their software out, and this is called Handsome Bigfoot, which is version 5.1.2. It says this hotfix release includes the block lookup efficiency fix, a fix to stop propagation of slashings for testers who have already been slashed. This is actually a really cool upgrade that they have. A fix to the disable up NUP flag. I don't know what that means, and a couple of metric fixes. This is a medium priority fix. So now why is this really good for people who got slashed? So say you have a node and you have 10 validators on there, and you are trying to move your node to a new machine, and you thought that it's turned off. However, it's not turned off. So what will happen is you'll put your keys on a new node, and then you'll double the test, right? And because of the way attestations work, there's 32 blocks per epoch, and each of your validators will attest once in that epoch. So your validator number 1 might attest in block number 1. If it does that, then you'll be double signing, you'll be double attesting, and you'll get slashed. Now, what would normally happen is if you didn't catch that quickly enough, as the blocks get proposed in that epoch, each time your next validator, like number 2, if that proposes in block number 3, then that would get slashed. Then your validator number 3 proposes in block number 5, that would get slashed, and so on until all of your validators would get slashed within that epoch. Well, with this, it seems like what would happen is as soon as your first validator got slashed, your your consensus client would turn off and stop you from validating anymore to save those other 9 validators from getting slashed. So I don't know if that's exactly how it works. It looks like that's how it works. So that was really cool. So if you're using Lighthouse and if you run multiple validators, it might be a good idea for you to set that up. Okay, next we had Evan here retweeting Scott. So let's go see what Scott says. So he says, The Big Boss Part 5. So this is a post from Scott where he's talking about the different avenues with which the SEC could deny the Ethereum spot ETF. Now, we all know that, we really want this to happen. We think it'd be really good for Ethereum and for crypto. But Scott here thinks that the SEC might try to reject it, and then tries to think of the different reasons for why the SEC might reject it. So he says, following leaks of SEC campaign seeking to investigate the security status of ETH, I have some thoughts. This is how this may fit into the current SEC landscape. And basically, the idea that he gives is that he quotes Paul Grewal here, who says ETH is not a security, it's a commodity. And then he says, beyond that, what's happening is that the motive meets opportunity. So the SEC has cases against Coinbase and Binance where the idea of trading securities actively being at the court level right now. So he says by approving this ETF, what might happen is that they kind of would put themselves into a position where they might lose those court cases. And then he says that, what would the SEC get out of this? Well, they'd be giving themselves more time. They'd be giving themselves some leeway. And then he goes on and talks about, why would they do this, right? And then he talks about how they would do this. So one of the ways they would do it is by using the correlation between the spot market and the futures market. But that has been getting much better. It's been going for 2.5 years now, supposedly, I think. And then what's happened is, for the first year, the correlation wasn't very good. But for the last year and a half, the correlation has been very good. So they were saying that, the SEC could deny that correlation alone, but then they'd have to kind of approve it in a year's time. So they might try to be kind of smarter with it. And then talks about how, this security thing is a way of kind of he says the follow-up to this state of affairs, the SEC desires further optionality to deny into 2025 and beyond, perhaps to avoid undermining this Coinbase and Binance cases. Correlation on its own is only a temporary waning solution, and further optionality would require a rethink. So then that's where he says that they have to be very careful in their reasoning for denial, because that's what got them trapped with the Grayscale lawsuit, where they gave a reason for denial. The reason was proven wrong. So then the court overruled their denial, and that was it. The Bitcoin ETF came about. With this one, they've kind of might have learned their lesson. So they're going to be a lot smarter with the kind of denial that they give, so it doesn't just get overruled right away. It says a failure to raise non-correlation analysis objection in May denial could prove costly in the future once correlation came in line with BTC. So that's the point that we were making. And he says, basically he just goes and gives like about how there's a lot of political pressure, and Gary Gensler received a lot of flack from certain politicians about accepting the BTC ETF, even though the court told them they had to. And basically, I think it's setting the stage for Gary Gensler to kind of go nuclear, to go out on his own and just deny it, and then let the courts decide what they're going to. So there's a lot of here, like he says, so if we assume Gary trends down this path, the question that raises to mind is, how is it implemented? In my opinion, it feels more likely the SEC, again, avoiding the collateral damage, hard designation by enforcement, might prefer to instead deny softly by an ongoing investigation. So what they'll say here is like, we are investigating Ethereum status as security, therefore we can't approve it now, so we're going to reject it. And then basically, if they go to court, they'll be like, it's an ongoing investigation, and then that might potentially take years, depending on how they wanted to go. So Scott says, could the SEC go full scorched earth? Absolutely. But I'll still hold my breath for the moment. I've heard reasonable arguments that this might be the case, so be warned. So there's definitely some rumblings around about why this the SEC might be trying to do this. And it says that's putting aside all of the atrocious reasoning the SEC would need to engage in to even make the security argument in the first place, as many have already made clear. So the idea is, the security status is all good. Like he started off with a quote tweet of with Paul Graywall right here in the second tweet. That's kind of where we stand right now. So Scott Johnson giving kind of letting people know that the bearish case for the spot ETF does exist, and this is how it might look, and this is what the reasonings for it might be. So go and give that a full threaded read. It's actually really informative. I really enjoyed reading it, as much as I wasn't happy with the fact that it was saying that the ETF might not happen, because I really do want the ETF to happen. But yeah, check it out. Okay, next we've got this tweet here from Jasper that he shares that was quoting David Hoffman, and he says, doing some detective work on the BlackRock token contract, and the redeem function on the build is connected to the USDC token contract. There's on-chain convertibility between USDC and build. So what's happening here is that if you have USDC and you are one of the approved people on the BlackRock fund, you could swap that for their build token and then start earning rewards on your build token, basically. So there's some interesting stuff happening here. But what's really cool is the BlackRock built this trust and or fund, or whatever you want to call it. I forgot the actual name for it. But it's on crypto rails on Ethereum, integrating with really big Ethereum projects, and that is really, really cool to see. Finally, I'm going to enter today's episode with some funny stuff that happened today in Discord. So Sneaky here says, is anyone watching The Three Body Problem? The Three Body Problem is a new TV show on Netflix based on a trilogy of novels, and they're sci-fi novels that are really, really great. When I read them, I absolutely loved them. I talked about them on Discord a bunch of times in trading and trying to get people to read them. They're really, really good novels. If you like sci-fi, you can absolutely love it. Even if you don't like sci-fi, they're really, really good sci-fi. I think you will really like them. So I was catching up with messages, and I said, is it out on Netflix already? I knew that I was coming, but I said the books are incredible. So I'm going to start watching it. So anyway, Sneaky replied to me and he said, yes, sir, it released on Netflix yesterday. Sorry if I start laughing. So he got a glitch on his Discord. So he basically put that message out 5 times. So, of course, in classic Discord fashion, what ended up happening was Jasper said, yes, sir, just got released on Netflix yesterday. And then just as Sneaky says, what's going on with my Discord? But then Marketer said got released on Netflix yesterday, and then Jasper again says it got released on Netflix yesterday, and then again, and then I started saying, yes, I just got released on Netflix yesterday. And Sneaky says, I have no idea what happened there. I said, I know what it was. It was, yes, I just got released on Netflix yesterday. So anyway, a bunch of people kind of going back and forth about it getting released on Netflix yesterday. And then the meme started. So I said, good news, everyone. It just got released on Netflix yesterday. And then I made say the line. Yes, I just got released on Netflix yesterday meme as well, you know, with Bart Simpson in the class. But that was actually like a really funny moment of just people being dumb, and I was literally cackling with laughter. And my wife was like, "What on earth is wrong with you?" But yeah, how can you explain that, right? So anyway, on that note, thank you all for watching, listening, and being part of the Rocket Fuel community. Of course, you know, it's the weekend, so I hope you all have lovely weekends. Stay warm because it looks like there's a cold snap coming in the US. And also, there's a chance that I will not be recording some episodes next week. I'm going to try to record, but there's a chance that I won't have episodes on Monday, Tuesday, and Wednesday. Of course, I will let you all know about, you know, when I'm going to record. I'm going to try to record. That's like my plan, but there's a strong chance that I won't be able to. But I guess you'll find out on Monday if there's an episode or not. But anyway, like I said, thank you all. Have a lovely weekend, and I will see you all on soon. Bye.